Hello, everybody. Ed Yardeni here of Yardeni Research. It's June 3rd. It's Tuesday. I was not able to be on the call yesterday. Since I run this thing, I changed it to today, and I hope it's convenient for you. It looks like we have our usual large gathering, so it doesn't look like it was a big inconvenience, and I do appreciate that you're flexible enough to join us today. Lots to talk about. First of all, with regards to the weather here in Long Island, it's absolutely beautiful. Finally getting lots of sun. We were getting lots of rain, but everything is super green around here in Long Island, and we're looking forward to a nice summer. It's supposed to get hotter today in the next couple of days, so we'll see if that sticks around. With regards to sticking around, maybe the stock market's going to stick around here for a little while. Looks like investors have become rather jaded about Trump tariff turmoil. I don't say that critically. I say that objectively. It's President Trump, and it's all about tariffs, and it's created a lot of turmoil. But while the stock market took a big dive on that from February 19th through April 8th, that's had a V-shaped recovery. Since then, we haven't made new highs yet. We probably will, if not later this year, then maybe next year. We have to get beyond this tariff issue. I think the administration, in my humble opinion, wants to put this issue behind them as quickly as they can. I think they're going to have a bunch of agreements. Maybe they'll be 5 pages long. They're not going to be treaties. You can't negotiate a treaty in 90 days, but there'll be a lot of good faith language showing that countries that we are remain important trading partners with, that the major ones have agreed to continue to talk in a framework that is acceptable to us. The question is, of course, on China. It doesn't look like that's going to happen very easily or very smoothly. But you never know what will occur in these negotiations. But again, I think the administration needs to get this issue behind them. They don't want to take a chance that it'll cause a recession later this year that could linger into next year. I think they want to move on to their big, beautiful bill and get that passed and sell it as a major accomplishment. The reality is it's mostly just an extension of the 2017 tax cut bill with some extra provisions in there. I haven't gone through every page of it, so I can't be certain that there isn't something radically different in there. But it doesn't look like it's going to do anything meaningful to the economy in terms of providing more stimulus. I think it's true, everybody knows, that if we don't extend the tax cuts, then that will in effect be a major fiscal slamming of the brakes, and that could very well cause a much weaker economy, if not a recession. Nobody wants that, and so I think we'll see the extension of the tax cuts for the next 10 years, and some of them that had been scheduled to expire will be made permanent. Of course, that's the problem, is when these things are scored by the Congressional Budget Office, they have to figure out what's permanent, what isn't permanent. Obviously, something that is scheduled to expire isn't going to have the same 10-year deficit impact as something that is made permanent. And right now, the estimates that are out there is that the big beautiful bill will increase the amount of debt by 4 trillion, and the amount of debt is anyway scheduled to go up by 20 trillion over the next 10 years. So it would add another 4 trillion. So the bottom line is that it's really isn't doing much for seriously getting us back on a more sustainable track with fiscal policy, unless you make some very bold assumptions about what economic growth is going to be. The Congressional Budget Office tends to be way too conservative in terms of their estimates of what the economy can grow at. On the other hand, they may be too optimistic about the outlook for interest rates that they may come down somewhat. Uh, Put it all together, and I think the Congressional Budget Office estimate is as good as any. As there's a few others that'll be out there, but I think it's pretty clear that we're not doing anything remarkably bold or radical to slow down the pace of outlays or to increase the pace of revenues, other than the revenues from tariffs, the duties from tariffs, and I think if the 10% tariff survives and it's across the board, then that could very well raise $300 billion at an annual rate, or every year $300 billion. So that's real money. It's 3 trillion over a 10-year period. And then, of course, while a lot of people are dismissing Musk's efforts with the Doge boys, it looks like they came up with 150 to $200 billion in savings along those lines. So that's that's another over 10 years. That's another let's say $2 trillion. So there are some revenue enhancers, if you will, coming out of the efforts with tariffs, and there's some cuts and outlays coming from the Doge boys. But meanwhile, we're all getting older. We're all using Medicare more. People who don't have Medicare and don't have other support to a large extent rely on Medicaid. And maybe there's some requirements that people who get Medicaid, if they can, if they're not disabled and can work, that they will in fact work. So we'll see how it all plays out. We have something concrete out of the House. We have not a clue what the Senate will do with it all. Even will they pass it? Might be a bit of a cliffhanger. I'm sure they will, but in any event, I think the administration would rather focus on that and bill it as a major fiscal event rather than continue to be dragged into this turmoil with regards to tariffs. Well, what else can we talk about? Why don't we talk about the economy? The economy has proven to be remarkably resilient. We're not that surprised by it. We were betting on the resilience of the economy over the past 3 years. We argued that the tightening of monetary policy wasn't just tightening, but is also normalizing monetary policy. And we argued that consumers might surprise us with their resilience. Why? Because of people like myself, baby boomers. I'm not retiring, but my friends are retiring. And we've talked about this many, many times before, that the baby boomers are sitting on $80 trillion of net worth. As they retire, their savings rate is going to turn negative because they don't have any labor income anymore. Maybe they'll have dividend and interest income, but that's not going to lead to, you'll still get a negative savings rate if in fact they retire and aren't making salaries or wages anymore. But they will spend, and they will spend a lot, and they will also, I think, based on my personal knowledge, share some of their wealth with their youngins. The young folks' life is very expensive. And so I think the baby boomers are helping their children, maybe with mortgages, maybe with mortgage payments, maybe with kindergarten payments, whatever. I think there is some significant intergenerational income and wealth transfers already going on. And by the way, I have some baby boomers whose parents have passed away and left them with a lot of money, so they were already in good shape, and now they've got even more money. So there's $160 trillion of net worth in the household sector. It's an all-time record high. We've never had a retiring cohort like the baby boomers that are sitting on an all-time record $80 trillion. So it's real money. It's not pocket change. And I think it dwarfs some of these other concerns that people had, like, well, student loans now have to be paid, delinquencies are going up. There's indications of stress among lower income, lower wealth households. That's all important. That's all has an impact. But from a macroeconomic standpoint, that may very well be getting more than offset. In our opinion, it is getting more than offset by all this extraordinary amount of wealth that the baby boomers have. So that worked out pretty well over the past 3 years for us. And the idea that the Fed was normalizing rates, not just tightening rates, and that the economy could handle it. Well, that worked out pretty well. Economy turned out to be less interest rate sensitive. The long and variable lags that were supposed to hit the economy, well, it's been awfully long enough, awfully variable, and it just hasn't happened. And we kind of dismissed the long and variable thesis anyways. To us, it's there's nothing long and variable about monetary policy. Monetary policy tightens. In the past, it's tightened up to the point where it caused a financial crisis. And then there was no long and variable lag. You immediately got a credit crunch and you got a recession. And that was the story. This time around, we had a very small credit crisis back in 2023 when a couple of banks blew up in California. That was dealt with very quickly by the Fed. We had no credit crunch, and the economy continued to roll along. Besides, the banks are in much better shape. They're not as exposed to risky loans out there. A lot of the loans are being made by private equity, private credit kind of sources of money. If they lose money, it's a it's a hit to a rate of return. It's not a major capital loss for a bank that forces the bank to cut back on lending. So we've said this before. The capital markets are very resilient. They're huge. They're liquid, and they have a lot of shock absorbers. Doesn't mean that there couldn't be shocks, but it does mean that when there are shocks, the credit markets can absorb them. And as I said, it has really more to do with hurting somebody's rate of return than creating a credit crunch situation. The other area we've been talking about is capital spending. And we pointed out that over 50% of capital spending is in technology. And we've also been arguing that we're in a digital revolution that started in the 1960s with the IBM mainframe, and that this digital revolution has a momentum of its own. It's all about processing as much data as we possibly can, as quickly as we possibly can, as cheaply as we possibly can. And we've achieved that. As we continue to achieve that, guess what? We find more data to process and so on and so forth. And I think the AI revolution is really the AI evolution of the digital revolution, in the sense that we are AI with the NVIDIA chips. The NVIDIA chips are basically can be put together into something that can be called a supercomputer. By the way, we gave you a link in the Monday morning briefing to a video on Stargate, I think it is, or Starlink. You can text me in the Q&A to correct me on whether it's link or gate. But in any event, there's a video of the construction that's going on. It was only a couple of months ago that it was announced as a kind of joint venture between AI Open and a Japanese investment firm and Oracle. And so you would think that they haven't gotten off the ground, but according to this video, the construction is full bore. It's going to be several acres of data centers. There's about 1,500 construction workers. Oh, thank you, Chip. Stargate. So the construction is going on now. Speaking of construction, so I think technology capital spending is not cyclical. I think companies have to spend on it in order to stay competitive, to stay ahead. But speaking of construction, that's kind of another area of resilience that the economy has demonstrated. And that is, in the past, higher interest rates affected the most interest rate sensitive areas of the economy, and they tended to be autos, and the auto sales are actually holding up very well. Americans are buying the F-150s and other monster trucks. Just go on the highway, you'll see them all. I'm driving around in my dinky little Subaru, and I'm not intimidated by these cars because my Subaru has a boxer engine, and it's like a Porsche with a very low profile uh, body on it, but it's a powerful engine, and I'll take on any of these in a drag race. But let's get back to the subject here. The subject is construction spending, and construction spending has actually weakened the past few months, but it's weakened at an all-time record high. So there's no sign that high interest rates have clobbered construction spending the way they have in the past. It's true that there's been weakness in housing-related construction. Multifamily construction has been somewhat weaker. New single-family housing construction has been somewhat weaker. But what people have missed is that home spending on home improvements is extremely strong. It's not quite as big as new home construction, but it's right up there. And so, as we've seen mortgage rates go up and people are less interested in moving, they've been fixing up their homes, and that's been another area of resilience. And of course, under Biden, a lot of money was spent on public infrastructure. I don't think that suddenly comes to a halt. I mean, we are seeing, for example, here in New York, JFK is under construction. LaGuardia is actually kind of got used to it. It's a very beautiful airport. It's certainly a lot better than what we had before. And now we can look forward to something like that with JFK, but they probably got another 2, 3 years, maybe 4 years before that's all finished. And so that doesn't just kind of stop because we've had a change in administration. And I don't think the Trump administration is suddenly going to take funding away from keeping that project going. And in addition to that, we've had non-residential capital spending, private residential, non-residential spending, very strong. Again, Biden's policies of spending lots of money on onshoring. We did see a huge increase in spending on manufacturing facilities, and it sure sounds like Trump has every intention of continuing that, though less with fiscal incentives, subsidies, and the like, and more by bludgeoning our trading partners and companies overseas to move their production to the United States. He keeps repeating that if you don't want to have any tariff on your product, it's simple, produce in the United States. And sounds like a lot of money is being committed. And again, you could be kind of cynical, skeptical, and say, well, yeah, they're committing this money, but it's not going to happen. Take a look at Stargate, the Stargate video, and you'll see that it looks like it's happening, and it's happening rather quickly. Okay, so let's look at some charts that are relevant to all this. By the way, I got some nice feedback from you folks on William Pesek. William joined us in early May, and I kind of view him as our Japan bureau. He has an extensive knowledge of Asia, but he's also covered the U.S. He's had a long, successful career as a journalist for Barron's, for Bloomberg, and now Eric left and came did some searching around and concluded that maybe William would be a great addition to our team, especially since Asia has always been important, and if anything, it's becoming more important. And you may have seen William's two articles today. One on the Chinese yuan. Is it ready for prime time? And the answer is it's not ready for prime time as a reserve currency. And then he did a story on the Japan stock market, and that the supports that the market has had, particularly from the BOJ buying ETFs, may be behind the market. And while it doesn't look to be particularly expensive, maybe maybe it's going to kind of have some issues because of some fundamental questions that William raises about the Japanese economy. In any event, it looks like the bond vigilantes right now are pretty have all gone off into that they've all gone off into Japan for now. Uh, right now, the U.S. things have certainly calmed down on the bond side. Well, let's look at some charts here. Stock markets had a V-shaped recovery. We've discussed the possibility of a V-shaped recovery in the stock market. We did that in early April, um, when the liberation tariffs were imposed, and when the annihilation days immediately occurred, we concluded that Trump would have to blink. And if he did that and backed off, there could very well be a V-shaped recovery in the stock market. And so far, so good. I'm inclined to think that it could get a little choppy here for a while. I mean, the market's no longer screaming buy as it was back here. The problem is the valuation multiple. The forward PE is back to around 21, 22. The forward earnings have gone sideways. This is what happens when you multitask. I got somebody at my front door here that, let's see if I need to answer them. Bear with me, folks. There's nobody there now. If you haven't gotten a ring system, it's really great. Thing tells you when somebody's just kind of approaching your door, and then when they ring the bell, obviously it rings, and you can look and see who's there. Yesterday, I had a conversation with somebody and told them I'm still 20 minutes away from home, and so we kind of agreed on meeting another time. But it's really cool. I recommend it highly. So the stock market's done well. Watching the price of steel, the tariff man is now also man of steel. He's increased the 25% tariff on steel and aluminum to 50%. That's been wildly bullish for U.S. Steel companies, not so much for European steel companies and other companies that used to export to the United States. Uh, I don't know much about steel, and don't know much about this particular series, but that's the only one that we could find that seemed to have an indicator to the U.S. domestic market, and that's hasn't really been doing much. It's a daily number. There's also the PPI numbers. We'll be searching to see if they got anything to show about steel. But you would think that there are a lot of steel products that it's going to take us a while to make here in the United States, and that the importers are going to have no choice but to import them at the higher price, and that might have some inflationary impact. By the way, while we're talking about inflation for a second, I looked at the Cleveland Fed's nowflation, and it's really pretty remarkable. For the month of May and the month of June, the CPI is showing numbers like around 0.2% month over month. So, the big surprise here could be that Scott Bessent, Treasury Secretary, has claimed the tariffs aren't inflationary. I find that a bit of a stretch, but then again, if the data proves him right, then it proves him right. So we'll see how that turns out. I think it's pretty clear that tariffs are a tax on corporations. Somebody writes that check to send to the Treasury Department, and it's an importer, a U.S. importer has to write the check. And then the question is, do they get a discount from their exporter, and do they raise the price to the consumer? The latest ISM manufacturing survey that came out yesterday, there were some quotes from companies on what they were doing about tariffs. And one company said they have every intention of passing it through to their customers. They're not going to eat it, and so we'll see. But that's not necessarily representative of what will happen here. But anyways, real GDP is looking didn't look so great in the first quarter. It was down 0.2%. That was a big upward revision from down 0.3%, but it was down. Some of the hardlanders got very excited when that minus 0.3 came out. So, oh, all we need is one more negative quarter, and technically speaking, we're in a recession. Well, it's not going to happen, but we had a huge increase in imports during the first quarter. That is a big drag on GDP unless it is offset by a big increase in inventories, which was not the case. I don't think we have, no, the inventories are not in this one because this is percent change, but let's look at this one. I think there's inventories in here somewhere. Let's look. No, I'm going to have to put it in here. But this is first quarter 2025. It's the contribution to GDP, and you can see that we had a big increase in capital spending, actually, and a lot of that apparently was technology equipment. So fixed investment was very strong in the first quarter. Personal consumption expenditures, not so much. Here's the services on PCE for the contribution to real GDP in the first quarter. The bottom line is the first quarter wasn't weak on the final demand side. It was this big surge in imports that had the impact. The imports are right here, I should point out. Okay, so let's go to figure 5, and now let's talk about the second quarter. The second quarter is looks like it's 3.8%, but that was just revised, and this is what it looks like now. It's 4.6% at an annual rate for the second quarter. Again, very strong capital spending, kind of confirming our story about the resilience of the consumer. We've got net exports now actually a contributor, and the reason for that is here. We had the surge in imports. Now the imports came right back down, so that's a positive for the economy. The consumers, back to that story, they remain relatively pessimistic, but it's been irrelevant because when you look at consumers' incomes, they've been very strong. Average hourly earnings, all-time record high in both nominal and real term. That's wages adjusted for inflation. This is wages adjusted for inflation again. And you can see that for all the talk about Americans have been suffering stagnation in their real wages for decades, that's not at all true. It's actually been an increase of about 1.3% per year on average on this trend, which I think compounds to a doubling in about 25 years. And here you can see that it's actually been growing a little faster than this trend. So the real wages are there. The number of hours worked, payroll employment, and the average work week, all-time record high. So that's a big contributor, of course. And as a result, wages and salaries in personal income, both nominal and real terms, all-time record high. Wages and salaries account for, let's see, we got it over here. Wages and salaries account for about 50% of personal income. Then you've got non-labor personal income, which is interest, dividends, rent, and proprietor's income. That's a significant component. And of course, the government social benefits. And the fact of the matter is that non-labor personal income also at a record high. And so personal income's been strong. Disposable income is strong. I'll skip through that. This is disposable income, excluding all the support programs here. Disposable income compared to where it was before the pandemic is at a record high. In real terms, in nominal terms, it's at a record high. So Americans are doing what they do best. When they have income, they spend. If they're happy, they spend. If they're depressed, they continue to spend, sometimes more so. This is personal consumption expenditures on goods and services in real gross domestic product, all-time record high for these, including for goods. Remember, there's this binge here of buying goods, and it kind of went flat, but now we're back at a record high. This is fascinating to me. This is personal consumption expenditures per household. Now I'm doing this in nominal dollars. So this is per household. Look at this, per household. Most of the growth in demand for goods has been because of more households, which kind of makes sense. Once you have a sofa, you have a sofa. So you need more households to buy sofas. And meanwhile, the services per household have increased significantly, accounting for just about all the per household increase in consumption. So it's become a very services-oriented economy, which isn't all that sensitive to interest rates and other factors. Um, you can look at the rest on your own. This is my favorite chart for the consumer, $80 trillion in net worth for the baby boomers. This is that story about construction. Construction spending looks like it's kind of maybe topping out here, but it's not doing what it's done in the past, which is going to lead the recession with interest rates going up. So construction employment, which typically goes down in recessions, is at an all-time record high. And then here's what I mentioned before about Americans. Maybe they're not moving as much, but here is the spending on home improvements, all-time record high, though flat at that level, but still that's pretty good. It's not quite identical to construction of new single-family homes, but it's pretty close. So let's take a couple of questions here, and then I'll bid you adieu, as they say in Shakespeare. So, Chris, hi, Ed. You have written about Japan twice in as many weeks across both bond and equity markets. Would you mind adding some color there? It has been a popular buy over the last couple of years. Yeah, take a look at today's morning briefing, and you'll see we addressed it again in terms of the stock market, and we're not wildly enthused about it. Same goes for Europe, and so we're still in the stay home camp. Hasn't worked out very well so far this year, but we think the trend for stay home is still there relative to go global. Cagdis, the last question, and then we'll move on to our own day jobs. Hi, Ed. Do you think a trade deal will be locked in with European Union by July 9th deadline, or the backdrop will escalate between the two sides? Also, if there is a call between President Trump and Xi in the coming days, what are the odds of fentanyl tariffs also come off for the Chinese post this call? Two good questions. Everybody can have an opinion on this. I'm no more well informed on this, but my hunch is that the European Union doesn't want to get into a significant brawl with the U.S., so they'll give Trump some sort of framework of understanding that will not lead to an escalation of the trade war between us and the EU. And again, I think Trump needs to declare victory here during the summer so he can move on to other things. And then with regards to fentanyl, I think it's a very good point. I mean, if the Chinese, give us something on that, and they should, it's outrageous when you think about what they're contributing to what they're doing in our country with fentanyl. It's a horror, and we won't get into COVID. That's a whole nother topic. But yeah, I think that's a realistic possibility. And Chris says thank you, and I say thank you all to all of you for joining. And we'll be back on schedule next week on Monday, and then I'm going to take a little vacation with my wife to Spain. I'm looking forward to drinking some sangria on a beach in Spain. So we'll either pre-tape it or we'll pass on it. I'll let you know. Thanks very much, everybody. Good luck.